Welcome to Money Matters on TV360 Nigeria. I'm Okpeyemi Owosheni. We start off with business news. The Nigerian Upstream Petroleum Regulatory Commission, NUPRC, has unveiled strategies aimed at reducing the cost of crude oil production to less than $20 per barrel. According to a document titled Outlook for the Upstream Oil and Gas Sector of the Nigerian Oil and Gas Industry for 2024 and the near term, that's 2024 to 2026. The current suboptimal level of crude oil production in the country ranges between $25 and $40 per barrel. Authored by the Commission's Chief Executive, Benga Komolafe, the document outlines NUPRC's plan to establish a framework for crude oil and gas transportation. To realize this objective, NUPRC intends to implement several measures. Firstly, it plans to establish a framework for oil and gas transportation. Additionally, the Commission aims to incentivize investment in oil and gas infrastructure to enhance domestic delivery and stimulate the deregulated domestic gas market through streamlined administrative approval processes. We'll go on a short break and be back with company news. Welcome back. The pioneer managing director of Asset Management Corporation of Nigeria, Mustapha Chikeobi, has said that the corporation was no longer useful in the banking industry. Amon, established in July 2010 by an act of parliament, was meant to provide stability for the financial system by efficiently resolving the non-performing loan assets of the bank. Speaking at the Business Day Policy Intervention Series with a focus on the banking sector recapitalization on the 3rd of May 2024, Chikeobi claimed that Amon had outlived its usefulness and was constituting a major source of expenses on bank books. Chikeobi, who is the chairman of the Bank's Directors Association of Nigeria, said Amon was created for an emergency that would have dragged down the banking sector. According to him, without Amon, the banking system would have collapsed. He said it was necessary at the time it was implemented, but it is no longer necessary today. We'll go on a break now, but when Money Matter returns, we'll be discussing CBN standing firm on loan deposit ratio policy. Don't go away. Welcome back. The Central Bank of Nigeria has justified its reliance on the loan deposit ratio to control the country's rising inflation, saying it is ready to do whatsoever it takes to reduce the inflation rate. The CBN's acting director of the Banking Supervision Department, Adetono Adedeji, who spoke on CBN Talk Today, a podcast recently uploaded to the bank's website titled Loan to Deposit Ratio Adjustment, says the use of loan deposit ratio LDR as a control measure for inflation started in 2019 when it observed that there was a massive showdown in credit growth. Speaking about the nexus between the LDR and the rising inflation, he said the last Monetary Policy Committee decided to purge the financial system of excess cash by raising the monetary policy rate. Now, joining me to discuss this further is economist Segun Sopitan. How effective do you think the Central Bank of Nigeria's reliance on the loan deposit ratio has been in controlling inflation in the country?
Well, I think the jury is still out on that. Because we are still waiting to see the impact of the overall policy direction of the CBN with regards to inflation. So loan deposit ratio obviously being only one of them. There's the cash reserve ratio, there's the loan deposit ratio, there's the NPR itself. So at the moment, inflation, instead of going down since the last NPR meeting, has actually gone up. The loan deposit ratio is one of the many policy instruments that the Central Bank of Nigeria, deploys to try and manage inflation. And at the moment, we still have to wait to see whether this has been effective or not. And that's because typically there's a lagging effect, in economics. It takes time for policy decisions to impact the economy in a tangible way that the people on the streets can feel. And then it takes time for the data regarding that impact to be collated so that we can then measure that impact. So it's a bit too early. Since the last NPR meeting, the inflation figures that came out after that, inflation still went further up to 33.2%. So, but that's not necessarily suggesting that the decisions of the NPR were not effective. It just simply means that we haven't, if the impact have not caught up yet with the data that we're seeing. So I think before we begin to see the impact of those decisions, we'll probably be talking June, July, maybe even August.
Okay, you just mentioned that it's a bit too early to decide. So now, what are the potential benefits and drawbacks of using the loan deposit ratio as a control measure for inflation?
Well, I mean, the loan deposit ratio is a policy that compels banks with regards to what percentage of their total deposits they have to use to create risk assets, or what we call loans in everyday parlance. So in terms of potential drawbacks, what you have is if you increase your loan deposit ratio, it would mean, for example, at the moment, loan deposit ratio within the banking system is 50%. That means that if your total deposit base, your total liabilities as a bank, deposits, not the entire liabilities now, just the depositors' funds, if that is, let's say, 1 billion, you are required by law in Nigeria today to use 500 million out of that to create loans. So if that ratio goes up to 65%, there are two sides to that coin. What that then means is that some liquidity, in quote, from the system will be mopped up, because part of those deposits will no longer be available, to those banks to do other things other than create risk assets. So if you increase it to 65%, for example, which is where it was until recently when the CBN brought it down, then what happens is that you have that bank being required to create risk assets of up to 650 million naira, leaving only 350 million naira for other activities, investing, in forex activities, for example, and T-bills and whatever other things that they decide they want to do. So that would mop up liquidity, in quotes, within the system, thereby curtailing inflation. However, on the flip side of that is that would also then create room for the banks to give out more loans, because you are required to use more of your deposits to create loans. So if you reduce the loan deposit ratio from 65% to 50%, what that then means is that the banks are no longer under compulsion regulatorily to create as much loans as they would have otherwise. So if you reduce your loan deposit ratio, then you have a situation where there are less risk assets are being created, which some might argue could starve the productive sector, who are the biggest users of risk assets and loans in our economy, of the badly needed credit. So it's a two-edged sword. If you reduce loan deposit ratio because you want to improve liquidity in the system, because you think inflation targeting is working, you may then constrain, the markets of badly needed credit, loans, loans within the system. So it's a two-sided coin, and that's why the CBN always tends to try to play a balancing game to ensure that you don't do damage on one hand while you're trying to pursue some positive objective on the other hand.
Okay, the Central Bank of Nigeria has raised the monetary policy rate twice this year. Now, do you agree with the decision to raise the monetary policy rate to purge the financial system of excess cash? Why or why not?
Well, the NPR being increased is obviously necessary because inflation was galloping, threatening to go out of control, or threatening to spiral out of control. The question is, the quantum by which those increases happened, the two times that they were increased, was that necessary? Some would argue that those increases were too drastic and could have potential damaging effects on growth. So increasing NPR from 18.75% as at the time of the first MPC meeting in February by 400 basis points, and then by a further 200 basis points to 24.75% where it is now. Some would argue that that is a bit too drastic. But the CBN have their reasons, and I think that in this case, we have to just say that wisdom will be justified of our children. We have to wait to see the outcome of those decisions to know whether or not it was a good decision to make. The reason the CBN gave was very simple. Liquidity in the system was simply too high. You had a situation where total money supply was trending almost towards 100 trillion naira. It's almost unprecedented. And there was obviously a need to temper that and bring that down. And that's one of the reasons that they increased the MPR so aggressively. The other reason was that because inflation is so high, it's important in terms of creating real, a situation where there will be real returns for investment in the economy. It was important to increase rates such that people that are investing in government securities, bonds, T-bills, could actually earn real returns on the yields on those instruments. So if you look at those arguments, then you could say, well, we understand why the CBN did this. But the danger and the downside of that is that would increase the cost of borrowing in the economy also drastically, which would increase the cost of goods and services that are produced by the people that are borrowing those monies at those expensive rates, which obviously could have a tempering effect on consumption, on just purchases in the market, in the system, which by further argument would constrain, increase inventories, stock, for these manufacturers, and that would constrain growth. So it's a balancing act, and as it were, unfortunately, we can only wait. The decision has been made, so we can only wait to see whether or not these decisions were good decisions or bad decisions. If we see inflation come down significantly over the next 3 to 4 months, and we do not see growth being reduced too significantly, when I say growth, I mean GDP, then we could say this was a good decision. We will not know until we see the numbers.
So how do you assess the current state of Nigeria's economy, particularly in terms of inflationary pressures and credit growth?
Well, the inflation, unfortunately, is still pretty high. One would have thought that with the relative success with regards to managing the exchange rate, where we've seen the exchange rate actually go to as low as 1,050 naira in the parallel markets, and 1,120, 1,150 in the official markets. One would have thought that that would have, an effect of reducing prices, of certain goods and services, those that are indexed or dependent on exchange rates. That, unfortunately, hasn't happened. And I think that the reason for that is the lack of stability in the policy framework of the central bank. The central bank has not been able to convince people that those gains were sustainable. And unfortunately, as a result of some pronouncements of the central bank governor, in the last 2 weeks, we've seen a reversal of those gains. We've seen the naira depreciate further, go back to as high as 1,400, in the parallel markets, even though there's been some further gains again now. So there's a bit too much volatility with regards to exchange rates, which is unfortunately not going to allow inflation to abate. We must also remember that the factors that are driving inflation are not only demand pull. There's also the cost push inflation, where you're talking about the cost of goods and services as a result of logistic problems, as a result of, just simple inadequacy. Food, for example, food inflation trending at about 40%. Part of that is because, of the insecurity in the food basket of the country, which is unfortunately affecting supply side of the food equation. So that is not something that the CBN can do on their own. There's a whole lot of agencies of government that need to come to work hand in hand to deal with that part of inflation. So all in all, the economy is still, we're not in a very happy place as an economy. Growth has reduced. So the GDP numbers for 2023 have come in, and it's been a drop from 2022. And the indicators are, as a result of all of the inflation targeting policies of the CBN, it's very, very likely that we'll see a further reduction in growth of GDP, in the first and second quarter of 2024. So things are really, really not still looking a bit dire. I think we're still in an economic crisis. There's still a lot more thinking needed on the part of the monetary and the fiscal policy makers, and we still need to have a whole lot more coordination from those two sides of the equation before we begin to see some gains. At the moment, it's still a bit of hit and miss and just trial and error, frantically, desperately looking for answers, to questions that, sadly, we created by ourselves with some of the policy decisions that we made, in the last 11 months or thereabouts. So we hope that they will get things right as things go on, and we hope, more importantly, that the policymakers will have the courage to perhaps make some reversals, some policy reversals that may be required to put us back on track with regards to growth and stability within the economy.
Well, the CBN has introduced several policies in the past couple of months to address the economic challenges, one of which is the monetary policy rate that was increased twice, which you spoke on earlier. Now, do you think there are other alternative strategies or tools that the Central Bank of Nigeria could consider to address inflation beside the loan deposit ratio?
Well, the CBN has used the loan deposit ratio. They've also used the cash reserve ratio, the liquidity ratio. All of these different measures have been put in place. And of course, the NPR itself has been changed significantly, as we said earlier. So all of that is happening. But I think that one of the other things that the CBN needs to do and pay attention to seriously is our exchange rate management policies. I think that the CBN has to be a bit more circumspect in how we go about that, bearing in mind that a significant chunk of the Nigerian economy, circles around the question of the exchange rate. There's a huge proportion of the products that we consume as a country are imported, including petroleum products, which represent almost 50% of our total import bill as a country. As we speak today, we still import petrol. We still import a good chunk of the diesel, the jet fuel, the kerosene, that we use as a country. All of these things depend on the exchange rate. And then we still import a good chunk of our food. We import about 10% of our total import bill goes into food. Importation of things like oil, even poultry, rice, flour. There's so many other things that we import, in terms of food, before you then go into machinery, spare parts, and all of that. So many things that we import. So the central bank has to pay particular attention to its exchange rate management policies and ensure that the market gets a sense of stability, and assurance. So right now, we were on a good path, approaching some measure of recovery and stability within the market. But unfortunately, one or two pronouncements from the CBN and all of those gains seem to have been lost. The central bank must target getting the naira back to below 1,000 naira to the dollar in both the official markets and in the parallel markets. And one of the things that I think that they cannot run away from is intervention in the market. Nobody runs a totally free market economy with regards to the management of its foreign exchange rates. So the central bank governor coming out to say that it's a willing buyer, willing seller price discovery policy that they're running was a terrible, terrible message to send to the market. And you saw an immediate reaction where foreign portfolio investors pulled their funds out because what that meant was that there was no guarantee of stability of the exchange rates. So their funds were not safe. They pulled them out. The CBN needs to do a bit of an about turn and assure the markets that whatever it will take to defend the naira to a certain degree, that they would be willing to do. So what the CBN told the world at the beginning of all of this in June last year, thereabouts, or was it September, was that there's going to be a managed float system. The managed part of that means that you would have a band, of exchange of rates within which you want your currency to be, and you will do whatever it takes to maintain it within that band. If you just say willing buyer, willing seller price discovery, what that means is that if the market says that the value of the naira is 2,000 naira to the dollar, then so be it. If the market says it's 400 naira to the dollar, then so be it. No country runs its exchange rates that way, not even the United States, not China, not Japan. All of these countries they have a way of determining the range, the acceptable range within which their currencies will trade. So Nigeria cannot be an exception. And I think that if you talk about inflation targeting, beyond the MPR rate that has been used, beyond the liquidity ratio, beyond the loan deposit ratio and all of the other ratios, the asymmetric corridor and all of those indicators, beyond all of that, those are monetary policy instruments. Right now, exchange rate management policy must be focused on by the CBN governor, whilst the fiscal side of things are being handled by the Minister of Finance, the Minister of Interior, Ministry of Defense, Ministry of Agriculture. All of these people must also come together to ensure that we are targeting inflation from all angles. But for the CBN, I think that right now the next frontier for them has to be ensuring that the naira remains stable so that we can see price reductions. Because we must understand that even if the naira gains, people are holding inventories that they purchased that, based on the older rates, the higher rates. They are not going to bring their prices down until they are sure that the new low rates are here to stay. Otherwise, you will not see inflation abate. So that stability is absolutely critical, and it must be the next thing that the central bank governor must ensure that it provides to the market to give assurances to everybody that is operating within the economy.
The potential implications of the central bank's action on businesses, consumers, and overall economic stability in Nigeria?
Well, I mean, everything within the economy, is riding largely on the decisions of the central bank. Of course, there are other decisions regarding tariffs, regarding duties, regarding taxes, excuse me, that are going to come from the fiscal authorities, FIRS, and all of that. But all in all, by and large, the Central Bank of Nigeria affects a lot of, the economic activity within any economy. It's not just Nigeria, So that's why I have always advocated that the CBN job is not a superstar job. It's not a job for a guy that is receiving popular acclamation and adulation, from a section of society. It's not. It's a very serious job. It's a policy management role, and every single word that comes out of the mouth of the CBN governor has an impact on some part of the economy or the other. Therefore, there has to be some measure of circumspection with how, the CBN, the monetary authorities, and especially the central bank, communicates with the public. And I think that it's important that they recognize this and understand that their actions, decisions, and pronouncements actually affect everybody, whether they're small business, small scale enterprises, or large corporations or large multinationals. Everybody is affected by these things, and we have to be a bit more responsible with the way we go about things.
All right, just before I let you go, Mr. Sopitan, looking ahead, what factors should policymakers and investors monitor closely to gauge the effectiveness of the central bank's inflation control measures?
Well, I mean, look, one of the challenges that we have as a country, and that we've all known we've had for a while, is just the lack of availability of data. So one of the things that obviously you want to be looking out for is the inflation numbers from the NBS, from the Nigeria Bureau of Statistics. But beyond that, given the limitations that some of these numbers, come with, what I would suggest is that large organizations, I mean, even if you're not large, these things actually do affect your business. So you need to develop some sort of research and analysis competence internally, within your operations. A lot of organizations have research and strategy desks that conduct their own surveys and their own research activities to measure the direction of the economy. Some have price discovery operations where they go out and conduct surveys to determine what prices are doing, and they keep a record such that they can tell whether inflation is going up or coming down, and I think that this may be necessary given the fact that you really can't wait for governments to release these numbers all the time. The time within which you are waiting, things are happening within your business that you need to keep a tab on, you need to keep in control. So I would suggest that people develop the internal capacity to gather some measure of data that they can use to make their policy decisions as an organization.
Well, economist Segun Sopitan, thank you for lending your thoughts on the program.
Thanks for having me.
Well, that's it on this episode of the program. Many thanks for joining us. I'm Okpeyemi Owosheni. See you next time.